Okay, good evening, guys. Happy New Year to anybody that didn't attend the non-farm payroll. We had a very good non-farm payroll to start the year off. I decided that I've been a bit lazy, I guess, on the live trading front. So we traded some proper size, traded the S&P, averaged in nicely at the top, got a nice retracement. So I think we made about £144 or something. So not setting the world on fire, but some real money, trading in the live market. So we're going to do much more of that this year. Get involved in the trading side, trade a bit bigger size, because it doesn't really interest me trading smaller size. So I need to get involved and trade some bigger size and show you guys how to average in, manage your stops and be a bit more aggressive in these very, very volatile markets. So lots more to come as well. I'm going to start a planning and preparation session, and it's going to be the Monday after the Friday for the non-farm payroll every month. It's going to set us on our way, give some guidance, say where the key technical levels are, what market's going to be moving, what fundamentals to look out for. So just again, really trying to give you guys the benefit of my experience and just kind of set the month off in the right kind of tone. I think people find very lonely in the markets and don't really know what's going to be the markets in focus, what's going to happen in the euro, what's going to happen in gold. My predictions have been fairly good over the last few years. So I think bringing those predictions and ideas into a live planning session is really going to benefit everybody. So really we're starting the Trade for Life course again. I've revamped it and I've kind of just polished some bits out, modernized it a little bit. It's not really changed the core. Unfortunately, the Trade for Life course is what it is. It took me a long time to write, and it really is, the best foundation for understanding what the trading, world is all about and what you're trying to get out of it. And all the different modules, all these 10 modules are all very vitally important. And some you can discard, but only after you've listened to them. And I think it all really revolves around my 80-20 rule. The markets move 80% of the time due to technical analysis, because if the markets don't move, people don't make money. And the self-fulfilling nature of all the different things we look at, from Fibonacci, Bollinger Bands to support and resistance, and then the 20% underlying fundamentals that really do drive the markets, the fear, the greed, what's going to happen with interest rates, what's going to happen, to a positive job figure. All these different things come into the mix, and it's how we interpret them and how we actually go on to trade. So the first part of the course really is all about the theory of a trading plan. And this took me a long time to kind of get on board with that when I was a young trader. I, like most people, most men especially, I was very kind of gung-ho and I thought I knew everything. And I made a lot of money my first couple of days of trading. And I thought that was it, off to go and buy a Ferrari and, job done. Never turns out like that, does it? So trading became quite difficult for a period of time, and it's because I had no plan. I was just taking the markets. I was getting involved at silly times. I wasn't really trading with any kind of goal setting or outcome. So I'd make good money in the morning, and when I say good money, thousands of pounds, and then I'd spend all afternoon giving it away. And you come to the end of the month, and you hadn't really made much money, if any money at all. And you think to yourself, well, what's really the point in this? What's the point in trading? So without having these goals, a trading plan, you can quickly get disillusioned with trading, and I've seen this happen to a lot of traders. So again, everything I teach you is from personal experience. It's also from teaching a lot of traders. I've been doing this a long time now. So you have to understand and you have to believe me. This is the best way to get a good footing. There's a lot of information on the internet and a lot of it's good quality, but there's too much. Okay, so this is a concise way of understanding how you get involved in the markets, why you have a plan, what a trading plan is, and all the different modules, all the different elements that will help you become a complete and consistent trader. So before I start, as always, the risk warning. Remember that spread betting and CFD trading carry high risk of capital, resulting in losses that exceed your initial deposit. The Bible is suitable for everyone, so please ensure you fully understand the risks involved. Now, the information and comments provided here under no circumstance to consider an offer to solicitation of investment, nothing here into consumer investment advice. The information provided is completely accurate to the date the information is produced. And again, education only. Content of webinars, personal opinion of the moderator, not InterTrader.com. Content is not constitute financial investment or tax advice. InterTrader.com does not accept any liability of the content and comments made during this session. So how to succeed in trading? Now, people often ask me what's the best way to be a successful trader. Now, unfortunately, there's no definitive answer. Okay, what works for me might not work for you. What works for your friend might not work in the same way as other people that you know. The whole point about trading is it's very, very personal. Okay, it's almost an art form. And funnily enough, I'm actually writing a new course for InterTrader called The Art of Trading. So that's meant to follow on from this introduction and this foundation course. This is a bit more the nuts and bolts, really the kind of institutional investors versus retail traders. So that'll be interesting. That's going to come in February. So as I say, trading's an art form. It takes a long time to be an expert, and I don't think you ever master it. You can be a very good trader and be a very comfortable and competent trader, but nobody has ever mastered trading. And I would say, you can look at people like George Soros and Warren Buffett. They're not necessarily traders. They're more investors. Actual day trading is a real art form. To be consistent, day in, day out, week in, week out, month in, month out, is difficult because it's so volatile. It's so difficult, and so many things happen simultaneously. It's very hard, to get that profit, to bank that profit, and get out unscathed. So actually, day trading, I would say, is one of the most difficult elements of finance and investing. So with this in mind, I try and put the same point across to everybody that wants to be successful. You have to first plan, and you have to be prepared. Give yourself some points of reference, something to start with and build on. Okay, training's a marathon, not a sprint. Okay, don't want to go into these cliched sayings, but it really is true. I would say in my experience, it takes about a year of trading live and watching charts to be competent and consistent. It just takes a long time. You're not going to put £10,000 into an account and in 3 months be a millionaire. It just doesn't happen. And you can read whatever you want on the internet, and I'm sure everyone knows somebody who knows somebody who knows somebody who knows somebody. I know more people. I've trained more traders. I've seen it. I've been on live floors for 10 years. Okay, you just have to understand that these things take time. Because the markets are constantly changing, you never get a trade the same, you never get a day the same. So once you're comfortable and you can adapt your strategy around the markets, then you do become a good competent trader. But again, it takes ages, a long time to be a true, I would say, expert and a trader that can get involved in any type of market situations. So the basic concepts of a trading plan. Now, in my opinion, I think they should be written. Something for me and something I've seen over the years, writing things down, you kind of go into auto mode when you type in things down. When you write something down, it has more meaning. And this to me can be as simple as writing a couple of key levels or a mantra, or it can be just, I want to make, 100 ticks and risk 20. If you write it down on a piece of paper, it means something to you. It's a physical action. Again, this is just personal experience. If you want to type it down, that's entirely down to you. Set up a spreadsheet, of course. Anything you want to do that works for you is fine. But again, the whole point of a trading plan is it has to be yours. So I can give you a trading plan at the end of the session, but it doesn't mean that's going to be what floats your boat, what works for you. What you have to do is make it personal and make it something you refer to and that actually helps you. So if it wants to be long and complex, fine. If it wants to be short and concise on post-it notes, absolutely fine. There's absolutely no right or wrong answer. The fact is, you have to have some sort of plan. The length of it is down to you. Just having that idea of a plan puts you head and shoulders above other retail traders out there. So saying the kind of products you want to trade and you want to make profit is fine. It gives you a reference point. It gives you something to go back to, learn from, and build upon. As you become a better trader and as you do more things, both from the fundamental and technical side, you just know more and things will be more obvious. But for instance, you should know the first Friday of every month is non-farm payroll, at 1:30. That should be ingrained in your memory. If you're new to trading, you might not know that. So all these things, again, you only know from research, from going through it, go through the motions. So as you know more and do more, your plan will automatically be easier and also be a lot more concise. When you start, you have a lot of information. It takes you time to whittle it down to what's useful to you. So remember, when you're trading, you've got no one to be accountable to. So unlike if you're trading on a professional arcade, you have a risk manager, you have a floor manager, you have somebody looking out for you, a risk team. When you're just sat, in front of your PC trading your spread betting account, you're pretty much on your own. So sometimes these rules do help you, not just to get involved in trades, but also to stay out of trades. How many times have we sat there and done boredom trades, knew it was wrong to do, and lost money just for the sake of it, because we wanted to trade and we were bored? Yeah, by having a plan and giving yourself reasons for getting in a trade, if you can look at that and go, well, there was absolutely no point me getting involved in that trade. I'm looking for a close above a moving average. I'm looking for RSI to be over sold. I'm looking for Bollinger Bands to tell me we've found a level of support. I've gone into the market and I've sold, which goes against all my entry reasons and against my trading plan, and I've lost money. Okay, this happens time in and time out. Trading's all about making them small, consistent winners with a reasonable loss, and compounding them winners day in, day out, building them up from days, weeks, and months, and seeing it come together. It's not about them big wins. So we have to get rid of them impulse trades, and we have to just trade the plan. So again, key things to look at: how many pips or pounds do I want to make? You can put it in pip terms, percentage terms, pounds, euros. It doesn't matter. Again, we'll go into that more in the psychological aspect and module of the Trade for Life course, because it affects people in different ways. But you need to know what you're trying to make, what you're trying to achieve. So what's your stop? Okay, and make it quantifiable. Be in ticks, be in pounds, in euros. Know what each trade, each daily stop is going to be. Otherwise, you can see it spiral out of control, and it does happen every single day, and it happens to the best of us. So what products do you want to trade? Do you understand how they're correlated? If you're shorting, oil and you're shorting gold and the stock market, is that right? Are they actually, kind of inversely correlated or directly correlated? You need to know these things because there's no point doubling up your exposure or your risk. Then what are your overall goals and objectives and how are they measured? Okay, so again, goals are split into two parts, which we'll go into, but you need to understand what you're trying to achieve and how you're going to achieve it. Now, you're going to have to expect future changes. Now, the markets don't just change, but you will change as a trader and your plan will adapt. So as I said, trading is a marathon, not a sprint. Okay, so you need to know that in time, things will change. You will change. Okay, so if things don't go as predicted, there's no point to keep doing the plan over and over again if it isn't working. Especially when you first start out trading, you don't know what's right. You don't know what's wrong. Again, it's going to be difficult, isn't it, to kind of start off on the right foot. But if you start off with a basic set of ground rules, and things you want to achieve and how you think you're going to achieve them, at least then you can amend them and change them as you go on. So knowing when to amend and change this trading plan is something that can really only be learned with experience. As I said, it's you can do this whole course and you can have a foundation and understanding of what trading's all about. But you will have to refine that over the next 3, 6, 12 months. And it's not saying there are going to be massive changes, but there will be changes because everything does. You never start out with a perfect plan. Okay, life isn't like that. The markets aren't like that, and nothing where money's involved is like that. Things have to change, so you have to be open-minded, and again, be confident enough to know when things are working and when they aren't. So, Einstein's theory of madness is doing the same thing over and over again and expecting a different result. So, if your trading plan or style isn't working, don't just stick to it blindly. Amend it, change it. Again, be adaptable. So most successfuls in my experience, again, have given themselves time for this to work. It's another part of the planning process. You have to be bigger than one trade. You have to be bigger than one day. So you're not just going to get disheartened by one losing day. And also, you don't think you've cracked it if you have one winning day. So, as I said, it takes a long time to be good and consistent. So you need to be looking in terms of weeks, months, 3 months, 6 months, and years. Okay? So you need to measure each week against each month against each 3-month period, and build it up that way. You can't just do it trade by trade. Obviously you can do, but you need to look at also the bigger picture, because you always have to be bigger than one trade or one day. You have one losing trade, you have to continue. You have one losing day, you have to continue. Doesn't mean you have to do it in the same way, but you have to be aware that trading is going to take a longer than one trade or one day to be ultimately successful. So remember, your trading plan is a physical reminder of these rules and goals. They're meant to help you and guide you. And if they don't, then you need to get rid of them or change them, because everything on that plan, on that document, on that piece of paper, post-it note, whatever it is, has to be relevant to you and has to help you make a decision to get into a trade or get out of a trade. Otherwise, it's of no use to you. So as we talked about a little bit earlier on, your trading plan is all about goal setting. So what you want to do is make yourself, a good trading plan. Now, what does this consist of? Well, it's easy to speculate what it should include. And most things, like in life, the first port of call for most people is the internet. So you Google, what's a trading plan? What's the perfect trading plan? Now, again, as always, the internet is a great trading resource, but there's so many different opinions, there are so many different ideas. I'm not here to say mine is best. I am not and never have tried to approach trading as the masses do, or as the so-called experts out there do. What my course is designed to do is to teach you how to learn. So I give you all the ideas, all the framework and building blocks, then you put it into a plan. This means I'm not really swaying you one way or another. You put these individual building blocks into your overall plan. It's already your trading plan, not mine. And you have to trust me on this. This is for your own good. If I give you an exact trading plan and say this is how you trade, you won't A, follow it, you won't B, have the confidence you would have if you did it yourself, and C, it just won't mean as much. Okay, everything when you do it yourself means more. It's just the way it is. So trading is a very personal approach, and different things work for different people. Again, my whole idea of having a framework is something you build upon. So if you know the basics, you have to look at figures, you have to look at data, and that's 20% of the time. You have to look at in the technical side, 80% of the time. That's a framework. What you do with that is down to you. What you trade figure-wise is down to you. How you view fundamental data is down to you. How you use Fibonacci, Bollinger Bands, RSI, again, down to you. I can tell you what these things are and the way I use them and the way I see the market interacting, but it's down to you to put that into a framework and into actual actionable decisions to buy and sell. Yeah. So again, it's down to you to pick out everything from this course and make it relevant to you. So you've got two kind of main goals. So the first one is an outcome goal. So the outcome goal you're trying to set will be to make money. So I know, and it doesn't matter what I say, it's going to be to make money because that's why everybody trades. It's not just for the thrill of it. It's not because you enjoy it. It's to make money. So again, it's good to know these things, but it has to be quantifiable. To say, yes, I'm positive, I'm going to get involved in the markets, I'm going to trade the DAX today, and I'm going to make some money. That's great, but that's not quantifiable. You need to know how much each trade, each hour, each day, each week or month you're going to make in pounds or ticks, or percentage of your account. Because otherwise, how will you know if you're achieving these goals? You might make £10 profit, but have done 50 trades. Is that really worth your time? Have you really made enough money to warrant investing your time trading the market? So remember, time has an amount of money on it. So it's not just the point of spending all this time charting, researching, and spending all this time trading. If you don't actually make any money and can break that down into almost an hourly wage, then how do you know how much your time is worth? Don't be a busy fool. Don't spend all your time, turning over money and making money for the spread betting companies or paying for news feeds, etc. If you're not making money out of yourself, what's the point? So again, make sure this is realistic to the amount of capital you hold. Yeah, your goals have to be achievable, realistic. If you have £100 in your account, you're not going to make £1,000 a day. Okay, if you have £10,000 in your account and you're only making £10 a day, what's wrong? It has to be the right kind of balance. You have to make enough money to warrant the amount of money you have in deposit, and be realistic. You can only make money with money. So once you've got that outcome goal, you've got the process goal. So that is how you're going to do these things, how you're going to be profitable, how you're going to be consistent, what you're going to do. So you have to understand, again, the practicalities. When will you trade? Some people are morning people, some people are afternoon. Again, a lot of people ask me, when do I trade? Well, I never trade the Open. I never trade the US Open. It's too volatile. I'm trading on a spread betting platform. I don't have £1 million account. I don't have a huge amount of size that I used to. I have a relatively manageable, smallish, I've got about £7,000 in my account. So that's enough. That's enough for me to trade any product I want, average in and trade 2 or 3 products at a time. Okay, so I just trade that amount of money because then I know where I stand. I know that I'm not, the big, trader I used to be. I'm just an average everyday trader who can trade, with as much size as I think is relevant. And out of that money, I know I can make 10% of my account. Okay, so I can make £700, out of that money I've got on deposit. Okay, and that's good. If we can do that, that's really good. But even if I only make 2, 3, 4%, it's still good. It's still a big enough return to warrant having that money in the account. So I know from that amount of money I've got on deposit how much size I can trade, because I know from £7,000 I can trade 28 S&P. Okay, I know I can trade £28 with S&P because I've worked it out. I know the frequency of trade. I know I can be in and out often because I've got account money to allow me to do that. Will I average? Yes, I will average, because I do like to start off small and average into positions. I don't buy individual prices. I buy areas of value. So I'll buy over 5, 10, 15 prices sometimes. That's my style of trading. But I know I can do that because I've worked it out in what I can do with the amount of money I've got in deposit. This is where you need to be, understanding what you want to achieve for the money you've got. And are you going to use fixed stops, split stops? Where'd you get out? So again, it's what am I going to trade? When am I going to trade? How much? What am I wrong? What's my stop? And again, the average, that's down to you. I would say, buying at individual prices in these volatile markets is quite a high risk strategy. So I trade smaller, I average, and I trade a little bit more often. And that's how I cope with the volatile markets. So once we've got these goals and the process of how we're going to do it, it's important to have that assessment. So although trading tends to be all about the money, it's very important to make sure you keep a clear separation between actual physical money and trading the tick value. Okay, so it's all very well said, I want to make £1,000 and I'm going to risk £300. But it gets to a point when you want to scale things up, you don't really want to think in money anymore. You want to think of percentage of your account and just in ticks. It just makes things better. It makes it more achievable and makes things more not realistic. It's almost the opposite. It makes it less realistic. If you can think in percentage of your account and just think in purely numbers, it separates you. It takes that emotion out of it. This is why casinos use chips and not physical money. It's designed to allow you, if you do it right, that is, to take out the money element and make decisions based upon probability rather than actual money. Okay. So when we address this, we're going to talk about this more in the psychological and risk sector of this course. But really now, the whole point of this initial presentation is to get the idea of why we need a trading plan, all the ideas around trading that I know we need. So again, all your goals need to be timely and achievable. So remember, overall goals are the bigger picture. They're important. To start on your trading journey, you have to have good intentions. You have the most excitement, the most energy when you first start to trade. This gets beaten out of you. It fades. So you have to make sure your overall goals are achievable. You have an end in sight and you can tick a box and say, I want to make 10% of my account in 3 months. And when you do that, you either tick it or it's a cross. Maybe only made 8%. Fine. It's still, you've achieved, towards your goal. If it's just to make money and you don't make money after a month, you probably give up or you do a silly trade, you lose your account and you never trade again. I've seen hundreds of people do this. So unless your goals and overall goals are achievable, and again, be able to assess them, you're going to get very disillusioned with trading very, very quickly. So your individual trade goals, now this is the nuts and bolts of your plan. So where you're actually going to physically, what you're going to do. So that's your risk reward in each trade, when you're entering, what's your exit strategy, and what's your optimal return in this trade. So again, this all is ideas. So you need to know why you're getting into the trade, how much you want to make, and then how much you're willing to lose if you're wrong. Yeah, that's basically trading. And once you can do that consistently, yeah, and you can understand that in any market, then you're on your way to being a good, consistent trader. But as we say, that's the easy part. The difficult things are, well, how do you determine this? So what type of trader are you going to be? You're going to be a swing trader, momentum trader, scalper, fundamental, news trader, or a mixture of all types? How much risk are you actually going to do? You're going to do 1% of your account on each trade. Yeah, because that's what Google tells you to do. What's your risk reward? Is it going to be 2 to 1? Is it 3 to 1, 5 to 1? Again, that's what Google tells you if you Google risk. I don't believe in these ratios per se, but they do have a place in trading. What time of day are you going to trade? UK, US Opens all the time after work. Yeah. And what date are you going to trade? Non-farm payrolls, interest rates. Do you know what's moving the markets right now? So what sort of trader are you? Well, I mean, really kind of going down to it, and this really goes back to when I was writing my book, and I don't believe that there's a place these days so much for swing traders, momentum traders, scalpers, fundamental, the mixture. I don't think the lines are kind of that defined anymore. I think really we're all just momentum traders. Okay, so rather momentum traders looking for that short-term scalp intraday, so to get in and out quickly, catch that up or down move, or we're longer-term momentum traders looking for that bigger move to happen on the on daily charts and try and get a few days of movement. But again, it's all based around momentum. This idea we can pick the absolute tops and bottoms, too difficult. The markets are too volatile and there's too many big players out there, spiking the bottoms, the tops and key levels for us to be, consistent swing traders. And really, we're either overnight traders where we position or we're intraday traders where we scalp. So intraday traders, you're a momentum scalper. Overnight traders, you're a momentum investor, trader. Okay, that's how basic we can make it. Don't go too much into these old style of swing trading and all these very kind of outdated methods of trading that people talk about that they did in the 80s and 90s. The markets are too busy. There's too many people in the markets for these to work anymore. So you have to be again a much more aggressive, smaller, average type momentum trader or aggressive, smaller building into positions, overnight holding position trader. Okay, so that's how I see the markets. Again, you're entitled to your own opinion and you can trade however you want, but this whole point of picking the absolute bottoms and tops of markets, it's an outdated way of trading. The markets are too complex and they know this. So when you hear about the terms pin bars, stop grabbers, stop hunters, that's because they know you're trading. Okay, the institutions know how you trade. I know how you trade. Okay, A, because I've taught you, and B, because This is the way the market's involved. They know how you interpret technical analysis, they know how you interpret fundamental data, and they know you're generally running a 1 or 2% risk stop. So if the market moves any more than that, that's a stop grabber. I know if you go short after a positive, well, okay, this is the prime example. Non-farm payrolls came out, but it was just a little bit better than expected, but the underlying unemployment rate per hour was, the hourly wages was down. So the market went up. So I knew the market was going to go up on that initial data because it was better than the headline figure, but then it would come down. So the market goes up higher, okay, than the people shorting it off something else does, and it goes more than your 1%, and it goes maybe 2, maybe 3%, gets you all out of your trades and then comes down. So this is the reason why a good non-farm payroll, the S&P can go down 50 ticks before it goes up 100, because it stops people out knowing when they're right. Okay, so this is what we have to understand. And there'll be more about this later on in the course, and be more about this in much detail in the art of trading. But the whole point of technical analysis, it being self-fulfilling, is I know if you short a market when the market is an RSI 75 because that is overbought. I know I can push it to 80, 85, or the market knows, and get you out of your short trade before we then sell at a higher price and comes down. So the market knows how you trade, so you have to know how the market understands this and put that tolerance into your trading, because that's how professional traders, banks, hedge funds make their money, by getting the retail traders out, because they know what you're trying to achieve. They know how you're trying to achieve it. Okay, so again, another way of thinking, new world thinking. So what markets will you trade? Well, again, the style of trader can dictate the sort of market that you look at. Again, FX markets, trillions and trillions of dollars traded every day, the most liquid based in the world. Again, there's large fluctuations, and for a long time we've said the markets and FX markets can't be manipulated, but people have been charged with it. But you can't worry about that. The markets are markets. Big players, just have bigger accounts and can do more. I would say that the FX markets are good markets to trade because they are fairly transparent, I would say, and they are fairly liquid, so you can get out when you're wrong. If you're going to trade gold or something like that, for instance, or oil, you're going to have to pay higher margins, and you're going to trade less size, and it's much more prone to directional volatile moves. If you're wrong, you generally lose more money than you would in those style of markets than you would in the FX. So remember, all the markets have their own characteristics, like the traders themselves. Some are volatile, some have more size, some have different styles in the way they trade. Some are are very directional and have a big reversal. Some kind of peak and trough and range and then break out. So again, it all comes down to trial and error and experience. And it also comes down to a product of planning, understanding the market you trade, and just being able to recognize these patterns. So again, go back to the basics. If you read the Financial Times every day, maybe stick to trading the pound versus the dollar. Maybe stick to trading the FTSE. The temptation is to try and find some exotic market that nobody's ever found before, put a random bit of technical analysis and think you found the answer. There's nothing that isn't out there. Nothing, right? There is nothing. So you can't just suddenly go and do, I'm going to trade, a 23 period Bollinger Band with a 4-day moving average cross, blah, blah, blah. It's not going to happen. Okay, there's nothing you can do and put on the chart that hasn't been thought of. So you have to just stop that straight away. So understand what everyone else is using for their technical analysis and go with them when they're right and go against them when they're wrong. That's how you start to trade. And your plan, the way you interact with the markets, is your edge. So there's different ways of viewing the market. So the FTSE, for instance, is very fundamental and technical, good for position or momentum styles. Now, again, like I said, really for me, everything's all about short momentum, scalping, or long momentum, the trend. So for me, I still think the FTSE is going to hit 7,000. Still think there's upward movement in the indices in general, because where does a 1%, that hold 50% of the world's money put their money? Was it safe? Greek debt or Google shares? Shares are going to go up before they go down. So then you might have a different view. Crude, very, very fundamental at the minute. It's not technical trading, it's fundamental. Yeah, fundamentally, the oil market has changed, and now we're just looking to sell it as low as we can before we see a bounce. And again, then, a mixture of the two between the currencies and things like gold, again, different views. Is it the new safe haven, the old safe haven? Is it still relevant? Is it not? So again, it's building up that fundamental and technical view. So your entry strategy. So when we're talking about entry strategy, it's just how you're going to identify and execute a trade. So the important thing to know is that these rules are meant to facilitate the best trade you can do. So you don't want to have too many signals. You don't want to get involved in the markets too many times. Otherwise, they won't be consistent. But then they don't want to be too complex and complicated that you never trade. And this is the balance. So you need to find an understanding, be it fundamental or technical, what makes you trade. Okay, so we'll go through all the different ways you can later on in the presentation, but you need to understand that it will be a combination of fundamentals, combination of technicals, and it will be all the things that you need to know that make you push that button. So it might not be the same as me. You might see, right, RSI is over 80 on the hourly chart. We've closed below an upper Bollinger Band. I've seen a doji signal. That for me is a good enough 3 reasons to get into a trade. I'm going to go short and make 20 ticks. That's as good a trading plan as you're going to see. But you have to follow it through. If that's the way you want to decide you're going to trade, then follow that through different products. Build it up. But it has to be your idea. It has to be your, what makes you comfortable. And not to say you can't steal other people's ideas, not to say you can't, elaborate on other people's ideas, but it has to give you the confidence to say, right, I've seen this, 70% of the time, I win going short in this way. And you do it. You do that week in, week out, and you make money. That is trading. It doesn't have to be any more complicated than that. So ask yourself the following. Again, when you're talking about, what you devise for your entry points, what's he actually looking at? What is it you're looking at? And you almost need that mental or physical, kind of checklist to say, yes, I have understood this fundamental analysis. I know Mario Draghi saying that quantitative easing is going to be introduced, but it's not working, means it's bad for the euro. So I'm going to sell the euro when he says things like that. Or is it your trend lines, reversal patterns, candlestick patterns, oscillators? Now, when we talk about technical analysis, literally that's a whole section of the course on its own because there is so much of it. It's 80% of trading. So, you have to understand the difference between your indicators and your oscillators. Okay, you have to understand, your trend continuations, your reversals, your candlestick patterns. Yeah, all these things are massively important. But again, it's down to you to understand if these are good, weak, optimal trade identifiers, what they mean to you. And once you understand them, you can use them. If you don't understand them, don't put them on your charts and don't use them because you won't have the confidence in believing you won't press the button, therefore you won't make money. Confidence, and consistency build traders. So understand your technical analysis inside out, and once you have, put it on your chart. If you don't use it or don't understand it, don't put it on your chart. Don't get fooled into using things like Ichimoku Cloud. Don't get fooled into thinking there's some perfect scenario out there. There isn't. At best, you're only going to get a 70% edge. 70%, and that's absolutely fine. That is good enough. And it will be based around all the things I tell you that the rest of the market looks at. Your Bollinger Bands, your Fibonacci, your RSI, your MACD. Okay? Parabolics are. Don't have to go too complex for these things. Moving averages. Stick to what traders use in, day out, week in, week out. Because that's a self-fulfilling nature of trading. So exits, where you're going to get out. Now, a lot of people tend to put a little less effort into this. Now, the markets move very, very quickly these days. So again, when I was trading the non-farm payroll, I didn't get out on my first opportunity. And then I had to go back to a scratch position, and then go offside and sell some more before it then came back to my original position. Now, that really is not smart trading. When you've got to a good position, you should take your money out of the market, then get back in. Always be banking that money, especially when markets moving very, very quickly. So the reason for this is, you have an out. So you say, I want to make 20 ticks out of this trade. Okay, so no matter what, hell or high water, you take your money out for 20 ticks. Now, you don't have to take it all out. You can take half out. Again, this will come down to your strategy. But take that money. Don't leave it on the table. A market can go up and down in 15 minutes 10 times. And you can be buying, selling, making money every time. Don't hold on to it. And just let that trade, try and make the most out of that one trade. Take your money out every step of the way. Keep banking money. Don't leave it on the table. There's no medals for saying like, right, well, I've done this trade. I've gone long the S&P. It's gone onside 20 ticks 3 times, and then it goes on 60 ticks, and I take the money at 60 ticks. There's no prizes for doing that. You can go 20 ticks, make money, buy. 20 ticks, make money. There's no prizes for doing that. You can go 20 ticks, make money, buy. 20 ticks, make money. 20 ticks, make money. 3 times you made your 60 ticks, then it goes 66 onside, and you can make the difference. Okay? The whole point is taking your money out of the market when you can. That is trading. That's why we're trading a spread betting platform. And that's what we're trying to achieve. Constantly banking money when we're on side. Don't be a hero. Don't try and run a trade for 1,000 ticks. It isn't smart. It just isn't smart. You're a different type of trader. You're investing if you want to do that. If you want to be an intraday trader, get in, get out quickly, and just make the money. If your plan is to just let the trade run, then let the trade run. That's a different type of plan, but then you're a different style of trader. Okay, you can let it run for 1,000 ticks, but if something moves 1,000 ticks, you probably could have made 3,000 ticks out of that move. Okay, but if it's your plan to let it run, that's fine. Yeah, it's absolutely down to you. That's again, the whole point of why I'm doing this course is to tell you the framework. If you want to do a trade and let it run, that's your plan. Stick to it. Absolutely fine. But if your plan is to get in and out between levels, that's fine. Doesn't matter. There is no right or wrong answer at this point. If you've got a plan, then you're already a step ahead of the game. If you want to let something run between your entry and exit point, as long as you've got these two things, that is fine. So remember, no right or wrong answers here. So as again, it comes on to my point. These are your rules. Yeah, there's never a right or wrong way to do it. As long as you make money and you've got a plan, you're a step ahead of the average retail trader out there. Okay, so there's a fine line between holding trades and being greedy. Yeah, and that's the whole point of not letting your trades run for too long, because they inevitably will always retrace. But it's finding out, and again, it's down to your research. If your market will only move 100 ticks on average a day, then what's the point of trying to hold your trade for 100 ticks? You know you're going to have to hold it to the next day. Yeah, so take money out. All I'm saying is, don't be too greedy. Bank money as you're making it. So your trade management. So your trade management is really when you're in the moment, you're in the trade. And this is what's so difficult to do. Now, your trade management, there's a lot of things going on, a lot of emotions, a lot of different things to consider. So really, your trade management should be irrelevant. You should know where your entry point is because you've got into the trade. You should know where your exit point is because we just talked about that. And your whole risk strategy is where you stop when you're wrong. So really, you should have a stop, an entry point, and an exit point. 3 things. So you're either wrong, yeah, you're right, and you make your money. That's it. So your trade management should be pretty easy. Unless something new comes out, some new, fundamental news, or you see a big movement in the market, shouldn't really matter. So your trade management is just understanding, are you going to make the most out of this trade? If you're wrong, do you want to move your stop up? Or if you're right, do you want to move your stop down? Again, can be dangerous because that's changing the plan you've made. But again, these things are inevitable in trading. But realistically, trade management should be, am I right? Am I wrong? Do I know my out? Do I know my out for profit, and do I know my out for loss? And once you know that, trading becomes pretty easy. So you say, I get in at this point, I buy it, 1.100. I set my stop 10 ticks away downside, and I want to make 30 ticks on the upside. So put my stop in play. That gets stopped out. I've lost 10 ticks. If it doesn't, it hits my order to get out, and I make 30 ticks. 3-to-1 ratio. I make money. I do that 7 times out of 10. I'm going to be a good trader. Okay, easy as that. So, I mean, there's all these kind of self-talk questions and all these things, again, I don't want to kind of over-repeat them, but, these are the things you have to ask yourself to make up your plan. And they're going to be, what stop are you employing? You're going to do a fixed stop, so I get out for 10 ticks if it goes against me, or it's going to be trailing. Okay, so as my trade goes on side, it trails, 5, 10 ticks behind me, so I'm always getting out for profit. How are you going to manage your stop once you're on side? If you make your stop, or your target, sorry, very, very quickly, are you going to move your stop up? Are you going to get half your trade profit out, or are you going to run it all? So again, all these different things, you're going to split your stop. You're going to, change your risk through a trade. All these things you need to know. And I would say these come a little bit later on. What I'd say is, keep your trading plan pretty simple to start with. Have a finite stop, have an entry point, have an exit point. So 3 points. Yeah. The important part of your plan right now is understanding why you get into a trade. Yeah. That's the thing you need to do. Ken's just saying you can let your trade run, but keep checking if necessary move stop. Yeah, absolutely. And I think that's a very valid point, Ken. But I think you need to kind of come on to that a little bit later on. For now, when you're trying to start trading and build a solid trading plan you can build upon, it's having that entry point, having a finite stop, and then having an exit point, and just getting used to taking profit out, getting used to being wrong, getting used to being right. So stop, out, and again, the more you do these things, the more then you understand what your stop is in relevance to your market, how you can move your stop when you're trading, if you need to average more. And again, it's all these things are a learning curve. The whole point is your trading plan will change with time and how you experience the markets. This again is meant to be, a bit of a starting point and lots of ideas, lots of things you might not have thought about previously. But these are the things you need to think about in order to give yourself a fighting chance and having, that all important sustainable plan. So again, how are you going to trade volatile markets? Are you going to cut your size or trade bigger stops? Are you going to change your trade dynamic if you've lost, for a number of hours, weeks, days, months, whatever? And how often are you going to check your signals? You know, you're going to check the charts every 30 minutes, every hour. You know, again, it all goes down to what kind of style of trader you are. If you're a shorter term trader and scalper, you're going to have to look at the 15-minute charts and hourlies. If you're more of a daily, longer term trend chaser, you have to look at the 4 hourlies, you know, maybe dailies and weeklies. Again, trade management is all the kind of key to your real long-term success is by being comfortable in your own skin, knowing that when you put your trade on, you've got your stop, you've got your exit, and being comfortable to let that trade run, not tinkering around with it too much. Okay, not constantly, you know, messing around with the trade or thinking, am I right, am I wrong? You've made the trade analysis, you know where your stop is because of your risk, you know where your exit point is, your potential profit, and that you have the confidence to let the trade run. Okay. So your exit strategy, and again, like I've said, you need to have this really before you've entered a trade. It's all very well pressing the button to buy or sell, but you need to have that exit point. And I would say, really, when you're starting to trade for the first time, put an order in to say, I will get out some or all of my profit at this point in time, up or down the range. Okay, and then your exit strategy will kind of take care of itself because you're either right and you've got out for profit or some profit, or you're wrong and you've been stopped out. Okay, but have your entry, all the reasons for getting in that trade, and then set yourself an order to get out. And that can be the next key level, support resistance, or it can be a finite amount of money, or a number of ticks. Okay, the more you get into the habit of doing this, honestly, the easier trading is going to be. Okay, so a couple of comments coming through. Let your winners run. Yeah, absolutely. Let your winners run, but don't be greedy. Don't leave money on the table. You know, no matter how far you let a trade run, it will retrace because that's the way markets work. So, and they work very quickly. So you can be 20 ticks on side, and with the, you know, a few seconds, you can be 2 ticks on side. So would you rather go back in time and take that 20 ticks or let it run? Again, all relative, down to the time. You should be in the markets as short as possible as a beginner. Ben, absolutely. I totally agree 100%. If you're on side, yeah, take that money out. You know, again, it depends, again, how you set yourself out and how you position yourself, okay? If you want to be consistent in trading, you know, you want to be in and you want to be limiting the risk. And the limiting the risk is by being in the markets for less amount of time. Now, every time I've spoke to a successful client or all these different things, we're not focusing on being right. Okay, I know it sounds strange, but when you're a trader, it's not always about being right, it's about making money. So I want to be not wrong. So I don't want to go offside. I don't want to be taking lots of risk on. I want to be getting onside and taking money all the time. So every time I trade, I just want to be in, I want to be right, and I want to be out. Okay, so for me, it's about being in as quick as I can. I want to say quick as I can. That can be a minute, it can be 15 minutes, it can be an hour, it can be a day. But it's all relative to the amount of size I use and what I'm trying to achieve. I know I can't make £10,000 from one trade in a minute. It might take a day, it might take a week, but I know that because I'm trying to achieve that. So it all depends what you're trying to achieve. The less time you're in the market, the less exposure you have to risk, but the less money you will make. You can only make X amount of money in X amount of time. So that's the whole point of all this when you have a strategy, to understand your goal and what you're trying to achieve. Yeah, unless you're trading £1 million position, you will not be able to make £100,000. Okay? Yeah, in a minute. You can't, or in an hour. So size dictates how much you can make. So again, the exit part of your plan should include exit strategies for all types of trades you're likely to place. I mean, again, all the things I've just told you, you might say, well, I don't agree with you, Steve. I don't want to be a momentum trader. I want to be a swing trader. Or I want to be a position trader. Well, that's fine. Just understand that all these different styles of trading will involve the element of time. Therefore, will mean a different type of stop and a different type of exit. But it's all still the same, isn't it? You're trying to make X amount of money, risking X amount of money. So it doesn't matter what type of trade you are, the core of how you trade is still exactly the same. Okay? So again, I mean, you can exit the trades in different ways. And I think, you know, there's obviously a split decision on these things for many different people, but you can either take all your profit out, okay, at one fixed point in time and then get back into the trade, or you can split it and try and take more money out further on as that trade continues. Now, different for different people. So again, all I'm saying is that is it something for you to consider. I'm not saying it's right, I'm not saying it's wrong, I'm not saying there's a better way to trade than not. It's something you need to consider. That is the two ways you can get out. So again, I mean, it's all about the self-talk at this point. It's asking the questions why. You know, why did I decide to do this? Is it in your plan, or is it something you've just changed as because you've seen that profit or you've seen the markets move? So what level of risk are you willing to put on each trade? And what level of risk are you willing to take on each type of strategy? Because everything will be different. If you're staying in the trade for 2 or 3 minutes, then you can't be risking 50 ticks. If you stay in the trade for an hour, then again, you have to know how far your market can move in an hour. That's all easily done. You can look at the size of an hourly candle. You can look at the size of a daily candle. You should always know the averages. Averages of how far something can move, on the downside and the upside. Are you going to use fixed stops or split stops? Again, we'll come into that in risk. How are you going to exit for the trade if something new comes into the market? Are you going to be quick enough to understand and assimilate it, or just get out? Okay. How often are you going to check your signals, and how often are you going to reassess your exit strategy? And again, are you going to check these things weekly, monthly? Again, these are just ideas. All these things need to be compounding all the things I've already said, because a lot of people don't think about this when they start to trade. All they think about is, I've put £1,000 in an account, I want to make money. And I keep saying that's not enough. It's not enough to get you to that goal. So the psychology. So if you're not mentally prepared to trade, then chance of success is going to be very, very limited. There's a whole section on psychology, and it's something that's very underrated by professional traders, and I think some traders take it too far. At the end of the day, it's buying and selling. Okay, don't try and overcomplicate it. Don't try and get into the psyche of the market too much. Just try and understand how you want to interact with the markets, and then try and get in at a reasonable level. That's what it's all about. Don't overcomplicate these things. You need to understand how you're going to deal with stress. Okay, people deal with stress in different ways. People deal with trading money in different ways. Okay, the way you trade will not be the way I trade. Okay, that's just the way things is. So again, it all comes down to how you manage your daily routines, how often you take breaks, how you deal with the stress of trading. Sometimes trading's more stressful because you can't actually talk to anyone about it. You can't talk to your wife because they're generally not interested. People are only really interested in trading if you make money. If you lose money, they think you're an idiot. So the psychology of trading is it's a very lonely game. So the whole point again of having a plan and something you can refer to is it's your friend. It's someone telling you, and that's your own mind's decision, your conscious effort to say, right, well, I'm in a trade because of this, this, and this. I'm going to get out for this profit and out for this loss if I'm wrong, because I know because I've written it down, I've worked it out. Again, that could be the difference between a consistent trader and not. So again, the self-talk, the examples of how you're trying to assess yourself when you're trading, if you should trade, all these things you try and write out and understand, try and follow, how will your psychology, assess yourself from trade to trade? Will you give yourself, like a score out of 1 to 10, how good you are feeling? If you're feeling 1, why were you trading your entire account if you weren't feeling confident? Again, these little things are just tips. They might work for you, they might not. How often are you going to take breaks? Don't be a hero. Don't sit in front of your screen for 6 hours and don't move. Not going to do you any good. You're not going to be a better trader for it. How are you going to prepare for the stresses of trading? You're going to keep a diary of your mental state, or you're just going to wing it. You don't care. It's just money. At the end of the day, you'll either make someone lose some. Okay, and it works for some people, doesn't work for others. How are you going to deal with frustration? All the negative things come by a bad run. You're going to trade less. You're going to stop trading. Where do you call it a day? Where do you stop? How much is enough? If you don't have a physical amount of money, how do you know when to stop? And then how do you ensure if you don't under or over trade? What's an average? What is the most times you should trade in a day? What is the average amount of times you should trade in a day? Once, twice, 10 times, 50 times? Again, you need to look at these things. Again, it's all different kind of ways of attacking the same problem. I don't know you. I've never met you. I'm just looking down the list. Apart from Rudy, who are doing all quite well, I don't know you guys. So I don't know what to tell you. All I'm trying to do is say, this is the benefit of my experience. This is how I've taught people to trade. And these are the things you need to ask yourself and be aware of. And again, different things for different people. But I would say, from all the things I've spoke about today, I would say 3 out of 10 things will apply to everybody here. And it won't be the same 3 things, but 3 of these things will make all the crucial difference between you being a good trader and not. And that's just because I know, because I've just taught that many people, I've done it for such a long time, that I just know that there will be things that you go, yes, I get that, Steve. Yes, that's going to make a difference. Or, do you know what, Steve, that doesn't apply to me, but thanks for bringing it up. All about finding your own way. And that's what's going to make this trading plan more powerful. So, creating a trading plan. So we discussed all the reasons why we should have a trading plan. A lot of, kind of things to think about, a lot of theory, okay? But now it comes into the practice. So the practice is all about, what a trading plan is and what we're trying to achieve, and what we're trying to do, and what does it all look like, okay? So you can look at it as a business plan or anthology, you can look at it as anything you want. I mean, again, it's a process and it takes time. There's no way of fast forwarding through this. There's no way of just listening to an hour's presentation and then going away and being a successful trader. You have to start somewhere. And by starting with ideas, asking yourself difficult questions, setting yourself some basic rules, that's really all I'm trying to achieve. If you do one thing from this course and just set yourself an achievable goal, that's my job done. Okay? Not saying it's going to, suddenly make you an amazing trader. There are other things to consider. But if you just start in the right way, yeah, trust me, you're going to be better. I use it as the same analogy. I learned to play golf about 5 years ago. My uncle played off 20 and had been playing for 30 years. Okay, but he taught himself to play golf. I went and took a pro for 6 months, and within a year, I was beating him every single time. He played for 30 years. I played for a year because I had 6 months of lessons. I was taught to do things in the right way from the start, and I got confident, and I got better, and I beat him. So you can try it your way. Go out into the wilderness, learn whatever you want, read whatever you want, or you can do it my way, the tried and tested way. Okay, get yourself a plan, get yourself some achievable goals, follow me on my live trades, and make money. Okay, entirely up to you. I know 80% of the people in this room today will think, all right, Steve, well, I'll just try it my way first. Do that, and then come back and do it my way. Yeah, because that's the way it is. I know we're all individuals, and I know we're all trying to, put our own spin on things and think we know we can see things in a different way. Trust me, I've tried every way. I've seen everyone else do it every way. This is the way to start. By setting an achievable goal, sticking to it, trade in, trade out, week in, week out, month in, month out, analysing it, doing all the things in this course, and you'll be successful, or more successful. Okay? I've done this course now, I don't know, I've lost count, 20 times. People that follow it make money. I can see the figures, I know. So, what is a trading plan? What is the physical art of a trading plan? Okay, so I think it should be physical, as I've said. So you're going to get a PDF you can download and you can take away, print it out, do what you like with it. Write it on a piece of paper, copy it, scan it, whatever you want. Copy it into Excel, doesn't matter. The whole point is putting this theory into practice. I've told you lots of ideas, lots of reasons why you should do things, reasons why you shouldn't do things. And again, it's all conjecture. This is down to you now. You take whatever you think from all them ideas and then put it into a standard trading plan. Now, I'll give you a standard trading plan that I've used over the years because it's a framework, somewhere to start. You can do with it what you want. The next 8 modules all link together to put things into this document. Then we're going to have our rock, a solid wall of trading knowledge, and we can go out into the markets. Do not underestimate the power of having this. Both mentally and practically, having a plan makes a lot of difference. So your trading plan. So again, the one you're going to get looks very much like this. So we can start off, with a date, our basic things we need to look at. So what we're looking at the top, so you can do it by, a day, a week, or a month. Time specific is entirely down to you. You can fill in these one every day. You probably get bored and laborious, so I recommend you do this by week. Okay, so you can do your trades and top them up, through your account each day. But then, look for a week. What's your current balance? What you're risking for today, in percentage terms and monetary terms. What's your discipline rating? Maybe this top element you just put on a piece of paper and say, right, well, this week I've got £5,000 in my account. I don't want to risk more than 5%, of my account, which is X amount of money, and I'm feeling pretty good this week, so I'm going to give myself 7 out of 10, so I can trade, quite freely, because I think I'm going to be quite, risk averse and make some money. And then you just check on it every single day, add up the amounts each day, and then you change your current balance at the end of the week, and you see how that is. Okay, simple as that. Okay, your margin, remember, is the amount of capital we physically hold on deposit to open a position. So you start to know already. If you've got £1,000 in your current balance, your weekly target can't be to make £1,000 because you can make £1,000 with £1,000, but it's unlikely. So if you've got £1,000 in your account, maybe you want to make that week £200. Yeah, you want to make 20% of your account. Okay, so you know your risk for today, how much money that is, discipline rating, and you can do that every day. And again, every month, it doesn't matter. It's in black and white. It's something that you can use. So your target profit and your downside stop. Again, this can be for each trade. It could be for the day. It could be for the week. Again, it's your target profit. Should be what you're trying to make versus downside. So it could be I want to make 100 ticks this week, and I only want to lose 20. Or I want to make 100 ticks today and only lose 30. But whatever, as long as you put it down, okay, in black and white, you've given yourself something to aim for, something to do. It's your realistic target. you're trying to achieve. Doesn't mean you have to achieve it or not. Doesn't mean you have to stop. It's just something, isn't it? It's absolutely something. And then you've got your product and your upside downside levels. Your products, again, what you're looking to trade, maybe the FTSE, euro, dollar, gold, and just write down some key levels. So, have an understanding. If gold hits 1,247, I know that's probably a high side for gold. So I'll probably sell gold. So write it in red. Sell gold at this level. Okay? And then you've got it in your mind. Again, you've got it in front of you. And maybe you might be concentrating and you see, gold's spiking. Oh, we're at that key level. Okay, well, if we don't close above it on the hourlies, maybe I'll sell back into the range. Again, this can be the difference between getting into trading or not. And again, you can use lines on your charts for this, of course. But the physical action of writing something down, for the day or for the week or for the month, just to have it in mind, for me, I've always found to be very, very powerful. Then you process goals, write something down. Write something that means something to you. It doesn't have to be war and peace. It doesn't have to be, anything to do with trading. It can be a mantra. Be positive. Sell, high, buy low. Whatever. Whatever kind of gets you going. It might be something like, I want to stick to my risk reward. I don't want to lose my temper. I want to do 3 winning trades in a row. Anything. Something that gets you going. Something that gets you, thinking about what you're trying to achieve and why you're trying to achieve it. So again, a recurring theme in this course is to plan, plan, plan. So things like events, figures, and speakers, you should know. You should know the non-farm payroll is first Friday of the month, 1:30. You should know it. You should know if we're in inflation or in growth terms of figures. You should know if GDP is more important than PPI. You should know what PPI is, what CPI is. You should know what inflation figures are, what growth figures are. Okay? You should know all these things and know when they're out. So if you're trading long the FTSE and suddenly the non-farm payroll is coming out, then you should know what's going to happen if it's a good or bad figure. Realistically, you should be out of that before these figures even happen. Okay, there's probably 7, 8, 9 really important figures every month, and you need to know what they are and how they affect your market. Okay, so again, comes with planning and preparation. You need to know these things. The technical levels and patterns, something we'll really go through a little bit later on in the technical side. So all to do with your individual candles, hanging man, doji, your cluster formations, your head and shoulders patterns, all the things you hear about, all the so-called experts loving to harp on about. Know what they are. Know if they mean anything to you. No psychological levels, no key technical levels of support and resistance. Listen out for these things. Remember, you're trading against other people. They're self-fulfilling. So if I can see a head and shoulders, you can. So it might mean something to you, or it might not. And then you have the bottom, and that's your weekly, monthly targets. And again, depending on what your individual trade, plan is, then you want to know what you're in your running totals. What's your today's profit or loss? What's your weekly running, loss? What's your weekly, monthly, monthly, 3 monthly, yearly? Just keep a running total. So right, today made £100. That means I'm £300 on the week. That means my account's grown by X%. Almost like a balance sheet. So again, it might sound a little bit laborious and complicated, but it's not. It's just understanding what you've made in relevance to your overall targets. So what you make each day, should add up to a week. What you make each week should add up to a month. And that should all, again, revolve around your goals. See if you're making money. See if you're losing money. All these things, need to be bigger picture stuff. Because one day is not going to make you rich, but it shouldn't make you poor. A week should be getting you there. A month should be better. It should be more realistic to your yearly target. Okay, so you might make or lose £100 a day, but that can soon add up to being £1,000 or £2,000 up or down on a month. That's significant. Marathon, not a sprint. So the rest of the course, as I said, is going to be all the different modules. So all these different things will link back to that trading plan. And they're all ideas, they're all important, and you need to listen to them all. Okay, so I'll quickly go through the rest of the course. So we've got planning and routine. So techniques for setting up how you approach each trading day. Key elements for making the good traders into very good traders. Things like self-talk, checking your mental state. All these little things really make a difference. Being organized, saving time, not reading things, on stupid blogs. Just being organized, finding out where the data is, where the things are, where the economic calendars are, where the best sources of news are, where my trades are. All these things you should know, okay, and they should take no time at all. Key figures and how to trade them, we come and watch me. I trade 2 pieces of data live on InterTrader, and I trade the ECB and Bank of England on and the Fed, on FX Street. So 5 times a month you'll be able to see me trade live money. So why would you go and watch it anywhere else? Money management and being flexible on your risk, again, goes without saying. If you don't know what you're risking, how can you possibly know what you're trying to make? Yeah, always managing the downside. Rich people come risk because they take calculated risks, yeah, and they make money. They don't lose huge sums of money. That's gamblers. Using fundamental analysis, again, we need to be what's happening in the world. The world's a very complicated place right now. The natural correlations aren't working. The balanced portfolio isn't working. Nobody knows where to put the money. Okay, that's why the markets are so volatile. So we have to understand that 20% of fundamental analysis, and it's down to the figures, the speakers, and the type of markets we're trading. Key speakers, who moves the market? Who is it? Janet Yellen? Mario Draghi? Mark Carney? If you don't know who these people are, you shouldn't be trading. Okay, mental preparation and discipline, the trading psychology, yeah? How you want to control your own emotions, how you want to trade the markets, what you want to get out of your own brain, yeah? This is the discipline, this is the psychology, this is the thing that will make you a very good trader, okay? If you can't control your emotions, you shouldn't be trading. Using trend tools and oscillators, understanding the difference between indicators and oscillators, understanding these things that will give you secondary ideas of what the trend is trying to achieve. Okay, when do you buy and sell? Refining that buy and sell. Trend tools and oscillators, very important. Then variety of technical analysis. Every trader, again, from banks to hedge funds to individuals, will be using support and resistance, candlesticks and charts. Simple. If you don't know these things inside out, you're not going to last very long in the markets. So all these individual modules all revert back to your trading plan. Not going to last very long in the markets. So all these individual modules all revert back to your trading plan and try and give you an idea of how to achieve things. All right, guys. Well, I know it's pretty intense, to kind of get started. A lot of ideas, a lot of do I do this, do I do that? And it's all going to become clear in the next 4 presentations, right? But this is how we start. Asking ourselves some honest questions, trying to understand what we're trying to achieve, then going out into the markets in a responsible and controlled way, controlling our emotions, our risk, and where we're going to get out for profit. Yeah, this is real trading. So like I said, I'm going to back you up all through the months, guys, with live trades. There'll be 2 live data trades, and there'll be all my trades on FX Street. I'm on Twitter at Steve Ruffley, so you can always ask me questions. And again, I'll always give you, honest answers. Trading is hard. It takes a long time, to be good at trading. But anybody can make money trading. Anybody, if you approach it in the right way. Well, my view on today's markets is that, where else do you put your money? If you're the 1% or 50% of the wealth, where are you going to put your money? The indices haven't finished going up yet. Oil's going down, gold's going to go down. So right now, the best returns and safest places to put your money in stocks, because companies have more money on their balance sheets than countries. Government debt is very, very shaky, and the indices, and the S&P, for instance, are holding above 2,000. So every time we go low, we buy back up. Every time we reject a daily close lower, we open up the next day and go higher. It's been doing that for nearly a year now. So indices are going to go up. So everyone's just bottom picking. Simple as that. It's where your money's safest. All right, guys. Well, like I said, anything else, get me on Twitter at Steve Ruffley. That's the best way to interact with me during the day. And again, follow the live trades. Follow my signals. Anything else you want to get involved in, just ask me, guys. I'm here to help. And again, I'm very strong in my opinions. I've run this course for a long time. I've been an InterTrader for 4 years, and I know these things work. So take of it what you will, and again, use it for your benefit. All right, guys. Well, good to see you all, and it's been an absolute pleasure, and I'll speak to you all very soon. Great, guys. Take it easy. Thanks.